I want to start off by welcoming you to this webinar on the Underused Housing Tax Act. My name is Matthew Orrell, and I'm at the Halifax office of McInnes Cooper presenting today. This act is called the Underused Housing Tax Act. The biggest thing you need to know is that it really has nothing to do with underused housing. A lot of people misunderstood the requirements under this act initially, but they should have named the act something like the Reporting Housing Act, because that's the effect it will have, and I hope to convince you of that throughout my presentation today. So as I said, originally many people thought this act only affected non-Canadian owners. It came out alongside the Prohibition on the Purchase of Residential Property by Non-Canadians Act, but what we have since found out is that it does in fact affect both Canadian and non-Canadian owners of residential property alike. So a little history about this act. It was enacted in June of 2022, and they made it effective January 1st of 2022. The triggering effect for this act is ownership of residential property on December 31st of any given tax year. So the first year would be 2022, so December 31st, 2022. If you own residential property, this act would apply to you if you meet certain criteria that we'll go over in a moment. Now, the reporting date is similar to income tax. It's April 30th. This year, that falls on a weekend. So in fact, it is May 1st of 2023. Now, with that being said, CRA has recently on March 27th come out and stated that they will waive interest and penalties this first year until October 31st. So in fact, the effective deadline, I guess, this year for the 2022 taxation year only would be October 31st. Every other year, reporting annually is going to be required by April 30th, and if it falls on the weekend, then you'll go to the next business day. So a big question people ask about the act is, are there any excluded owners? Do I have to report? And luckily, there are many excluded owners. If you look under Section 2 of this act, it lists those under the definition of excluded owner. So some of those include a registered charity, a cooperative housing corporation, hospital authority, municipalities, different types of schools, Indigenous governing bodies, and as well, the big one is individuals who are citizens of Canada. And you'll see this first quote up on my screen here on the left, except to the extent that those individuals own residential property in their capacity as trustees of a trust or partners of a partnership. So right there, we know that if residential property is owned by a trust or you own it as a trustee of a trust or a partner of a partnership, you do need to report, and this act applies to you. The next big category that a lot of affected owners are corporations that are, and as you'll see in this quote on the right, it only pertains to corporations that are publicly traded. So publicly traded corporations are excluded owners. All other privately held corporations owning residential property are affected owners under the act. So under this act, if you're not an excluded owner, you're an affected owner, and that could cause you reporting requirements under the act. So as I just stated, the owners that are affected owners are trustees of a trust, partners of a partnership, private corporations, and then as well non-Canadian and non-permanent resident. That's the first qualifier, the excluded owner. The next portion goes into, you also have to own residential property in Canada. So you would expect residential property is defined under the Act. If you go to Section 2, it's also in there. So the properties that we're looking at that require reporting, they use very vague language, but essentially a dwelling unit is defined in the Act to be a residential unit that has a kitchen, a bathroom, and a living area. So if there's a detached home or similar structure with 3 or less of these, then you are required to report, even if no tax is owed under the Act. So right away, you can exclude many inquiries. If people ask, Do I have to report my vacant land? No, you do not, because there's no structure or residential property on that land. Likewise, if you have a big apartment building or a home with 4 or more units, you also don't have to report. So really, you're looking at any property identification number that's separate. So it could be a row house, a detached home, a semi-detached, a condo, anything like that with 3 or less units is going to be required to report. So as I said, under this act, just ignore the underused portion. Once you have figured out whether you need to report or not, you have to report, or you could be faced with the penalties that I will go over in just a moment. And that is, you have to report even if no tax is payable. So your obligations under the Act are twofold. You have to report by the deadline, and you have to pay the tax that would be owed under this Act if that applies. So your reporting obligations include reporting, filing a form UHT 2900, it's called. It's quite extensive. It asks for a lot of information, and it's about 6 pages long. And you do have to file this every year that ownership of a residential property applies to this act. So as I said, this year the reporting deadline is effectively October 31st, but they still have it as April 30th of every year. You will need to file this return if you own residential property in the ways that I previously mentioned. So if we look next at the tax owed under this act, and there are exemptions from this tax, and I'll go over those in a minute. But basically, you're looking at 1% of the greater of the assessed value for tax purposes, so what you get on your property tax assessment, or the purchase price. So whichever one of those two values is higher, you will take 1% of that and it'll apply to that residential property. And then you'll see ownership percentage here. That's if you own the property, you know, a husband and wife both own a property, they'd be found under the act to be 50-50 owners. So each would own 50% of that value and pay tax on 50% of that 1%. That being said, there are partnerships where different percentages can be agreed upon for ownership. And in those situations, obviously you would just multiply the 1% tax calculated by your allocated ownership percentage. Now, you'll notice down below here, I have or fair market value. That is, if you choose to elect, you can elect to pay the 1% on the fair market value of the home. To do that, you actually have to get an independent appraisal by someone that's at arm's length and have that completed. And in that case, the 1% would only apply to the fair market value of the property. So that is an option. It does involve that independent appraisal, and you'll have to actually complete that before you calculate your 1%. So if you're trying to meet a deadline, you'll have to have this done before then, obviously. As I mentioned, there was exemptions under this act. There's quite a few of them. I listed some of the more popular ones that I've been using for clients here. And it's good to know that you need to understand all these exemptions. CRA has come out and stated that you don't just check off every exemption that might apply. If someone checks off multiple exemptions, they're only going to look at that first one. If they find it doesn't apply, the tax will actually be owed under the act. So you want to understand the exemptions, and really you want to understand them so you pick the best one. You could down the road, CRA could come and say, if you relied on one of these exemptions, they could say it doesn't apply. So you really want to pick something that you can document well and document appropriately. So if CRA comes after you, 5-6 years down the road, you'll have your documentation to rely on and prove that the exemption does in fact apply. So again, don't select multiple on the form. In that case, you're just going to get the first one that they look at, and the rest of the ones that you check off are not going to be applicable for the form. You can find these exemptions in Section 6 of the Act. And some of the key ones would be a specified Canadian trust or partnership for the trust. If all beneficiaries and trustees are Canadian citizens, that would apply. And I do caution that a contingent beneficiary of a trust could put it offside for that beneficial interest test that applies under the Act. Another big one in the Atlantic region would be vacation properties. If you use that property for 28 days and it is in a prescribed area, it is eligible for a vacation property. CRA has a tool out where you can go online and just type in your postal code and it'll tell you if it's in one of these prescribed areas, but typically they're in just more rural areas and not city centers. So the exemptions, again, found in Section 6, you do want to be strategic in which ones you are picking. So another big question that people ask me is about the penalties. And the penalties are a minimum for an individual failing to report is a $5,000 minimum penalty. Now these penalties do increase over time. Every month that the property is not reported, you will incur a higher penalty. And really there's no maximum indicated, so these penalties can get quite excessive. For a private corporation owning residential property, the minimum penalty is $10,000. And just like I said, it adds up over time. So every month that the property is unreported, the penalty is only going to increase. Another caution would be that if you fail to report by December 31st, you can lose some of the exemptions under the Act. A lot of times, these aren't crucial exemptions for Canadians, but I've worked on a number of reports that if they did not report by December 31st, it is the only exemption that would apply to them, and they would then have to pay the 1% tax on the property, and they wouldn't have to if they report it by the end of the following taxation year. So how do you comply? You can call me. We've been helping clients deal with these reporting obligations. So please feel free to reach out if you need any assistance or if you'd like to just inquire whether you need to report. For that, we're doing a fixed fee service. So we're doing an initial report depending on one owner or one property. And then if other reports are required for, if there's 2 or 3 owners of one property, it'd be the initial $1,250 and then $500 per report after that. And this is a fixed fee service. We're just doing them. And then there's other fees that could come up. Businesses are going to have to actually apply for an RU number, which is a program account number. That could increase it. And non-Canadian, non-permanent residents might have to apply for an individual tax number as well. So that would be an additional fee. To figure out whether you need to report, we've actually come out with a self-assessment tool. I'll just show you what that encompasses now. So basically, it gives a little blurb of how this act applies, who it may affect. As I said, trustees of a trust, partners of a partnership, privately closely held corporations, and then non-Canadian, non-permanent residents. And it basically starts at the qualifying questions that I mentioned. So are you an excluded owner? This basically asks how you own the property. And if you click any of the excluded owners, you obviously will get a trigger that reporting is most likely not required. But if you're not an excluded owner, you are an affected owner. And if you are an affected owner, you'll get prompted with a second question that asks, is this residential property under the Act? So if you had a detached house or similar building, then you would click that and it would spit out the option for McInnes Cooper to assist, but at least our clients can check to see if they require reporting. Just like the previous question, if you state none of the above apply, you don't actually own residential property, and therefore reporting is most likely not required. So if you'd like the link to this tool for prospecting clients, please reach out to me and I will provide it to you. Next, I'm going to just go over a couple of the questions that were provided when people signed up for the webinar, and there was a lot of good ones, so thank you very much for that. The first one would be, would this act apply, have any impact on unoccupied estate property that is tied up in probate? And yes, it would. It is likely that you would have to report for someone that is deceased. What is the last sale price of the property if it was a gift or due to death of an individual? CRA really hasn't said much on this. I would expect it would be your cost base for the property or the cost base of the person that gifted it to you. Again, it's more likely that this value is going to be less than the assessed value for property tax purposes. So you'll probably just have to use that number and give a best guess of what the most recent purchase price was. Clarification on if CCPC obligations to report if they own residential property. And that's a straightforward question. If you own residential property as an affected owner, you are required to report. Even if you're exempt from the tax, you do need to report. Do all partners of a limited partnership have to file an underused housing tax return, or is it just the general partner? It really depends on who's on the land title. If you're listed on the land title, you're going to have to report. If it's just the general partner that's listed on the land title, then they would just report. So look to the land title to determine who needs to report. What is defined as unusable or usable year-round? So there are exemptions, as I mentioned in Section 6 of the Act. The residential property, if it's not suitable for year-round living, so let's say in Canada there isn't a heating source or there's no insulation on the property, that would consider it not usable for year-round use. In addition, there's another exemption that states if residential property is seasonally inaccessible because of public access roads to it. So that could also create a situation where the property is unusable and that you still have to report it, but you'd be exempt from the 1% tax. A really good question I got here was, if a husband and wife own a rental property and they only collect rent from their tenants, is it co-ownership or is it a partnership? And CRA actually has some direction on this. Most of the time, if you own the rental property with one or more other people, you are considered a co-owner. And it really comes down to the test of, is it a partnership? Rental income from a rental property is just income from property. It's not, income from carrying on a business. Something more would have to be done before you kind of meet that partnership threshold. But if you, let's say, own an Airbnb and you're doing the cleaning and other services involved with that rental, perhaps you're coming closer to that partnership agreement or partnership territory where you might have to report that. Income tax folio S4 F16 C1 it just goes over what is a partnership, and it might be worth referencing that if you don't fit into that clear cut, just owning rental property with one other person. But again, this is a very fact specific scenario, so you would want to check to make sure that it doesn't fall in that partnership category. Another question was, why are the penalties so high for the failure to file a return with CRA when you don't owe the money? And really, I wish I knew that. It could be compliance. It might be just CRA trying to gather a lot of data, trying to ensure that these reports are filed. They are quite significant penalties, though, for something that has just come out, and I believe most people don't even know about them right now. So hopefully by October 31st, more people know and everybody meets their reporting obligations under this act, because these penalties are quite severe for just reporting something that you otherwise would not have to pay tax under, because the most often people will not have to pay tax. If you own a home in a second province and regularly travel between each, spending 50% of the year in each province, do you need to report if you are a Canadian resident? And basically, you don't have to worry about the use as much as you have to think about how the property is held. So if you hold the property in a trust, a partnership, or a corporation as a Canadian resident or Canadian citizen, you do have to report. Again, it doesn't matter if it's underused. If you're not using one, you still have to report it. The portion of the time you spend in it might come down to an exemption. One of them you could claim as your principal resident. The other one, a vacation property exemption might apply, but you do have to report both if they are held in a trust, a partnership, or a corporation if you are a Canadian citizen. So just be aware of that. So do residential rental properties owned by a husband and wife who are both Canadian residents qualify for filing purposes? Just owning the property in your individual names and, assuming you don't do any other services except for, rent the property out, you probably don't meet the partnership test. So you would not have to report if it's in your individual names, if it's just you owning it as an individual, even though you rent it out. But again, the partnership question is a very fact-specific question. So definitely ensure that it's not a partnership before you do not report, because the fines are quite significant. Principal residence in a cottage held in an alter ego trusts, is there exemptions? So there are exemptions. The principal residence exemption would be one. And if it's held in an alter ego trust, you could also look towards the qualifying Canadian trust definition, which is an exemption under Section 6 that could exempt you, depending on who the beneficiaries are. That might be another exemption you could use. And again, it's likely in the Atlantic region that if you have a cottage, it's in one of the prescribed areas, so the vacation property exemption might apply as well. Another question is, if you paper file without an RU number, will one be assigned? And an RU number is for a privately held corporation that has a business number. You need a program account number, and it's called an RU number. If you file without the RU number, CRA has said or has told me over the phone that will be considered an incomplete application. So you will need to take that into consideration when you're planning to report. Don't start looking for this, on October 1st and thinking you won't be impacted by penalties and interest, because these numbers do take 4 to 6 weeks to obtain. And if you don't get that number, it's more likely than not that you're not going to be able to report on time. And another question in the chat is, I am a citizen of the UK and I own a home in Newfoundland, but it does not have an address. How can I complete the online registration form? So that's a great question. I would most likely you're going to have to find some approximation or get the closest thing to an address for that piece of property. I have dealt with quite a few in Newfoundland, and I do know that their Land Registry Act is quite sparse, I would say. Certain areas definitely, I've come across it where they don't have the address. If they send you any information for property tax purposes, I'd look to those documentation or reach out to your municipality and just try to get something to properly fill out the form. But I would be proactive in that approach, because it could take some time to actually get the address that you need to file. Again, I would do my best effort to get some sort of an address, or close to an address that you can, and I'd probably reach out to a municipality to try to assist with that. Another question is, are Canadian citizens and permanent residents who are non-residents still excluded owners? So yes, they would be. If you own it solely in your capacity as an individual, as long as the property is not in a trust, partnership, or a corporation, if you own it and you're a citizen of Canada and you live as a non-resident of Canada, like if you live in the States, but you are a citizen in Canada, you don't have to report and you're considered an excluded owner, so you don't have to report there. Another question was, what constitutes a partnership? I own a home with my sister, but she lives in it as her principal residence. So that would not, most likely not constitute a partnership. When you're looking at a partnership, you're looking at a 3-point test of, are you carrying on business in common with a view of a profit? If you meet those 3 criteria, it's likely a partnership. But if you just own property with someone and someone's living in it as a principal resident, that's not considered a partnership. The next question was, an individual owns 10 residential buildings with 2 units in each. Do they need to file a return? Are they exempt from the tax? That's a great question. They don't have to just file 1 return. They have to file 10 returns. It's per property that you have to file these returns, and you're also going to have to include the information from all the other residential properties you own in each return. And the exemptions, I can't really answer that without getting into more facts. It's a very specific analysis, but there are exemptions that might apply to most or all of those properties. But again, it depends on a lot of different factors and how the property is owned and what the use is, what agreements are in place, everything else. So you will want to go through the exemptions and try to fully understand those before you start applying them to that scenario. What would you use for an assessed value if it is not located in an incorporated municipality? Not really sure on that one. The assessed value, it would just, whatever you're paying, property tax on would be what I would suspect. If you're not paying property tax, I don't know. I'd probably reach out to someone to inquire further on that. I haven't come across that situation yet. What about a fishing and hunting camp where there's no running water or power and the bathroom is an outhouse? No shower. Would that be considered a dwelling unit and therefore caught by the rules for a filing requirement? So it would depend on that scenario. If it had its own bath, kitchen, and living area, then it would be residential property. So right away, there's no bathroom. The bathroom is an outhouse. I'd report just to be safe. There is an exemption because that would be considered, not capable of year-round living. But I would likely report that just to be cautious because the penalties are so significant. If a corporation owns a building they are operating out of, do they need to report? Again, you're going to look at that dwelling unit definition in subsection 2. If it meets that requirement, and it's the definition of residential property says a detached home or similar building, you will likely need to report if you meet the dwelling unit requirement and it is capable of living. I would report that property because it is owned by a corporation. So I think the questions have slowed here. I don't see any more coming in. So with that, I'd like to thank everybody for your attendance. Please feel free to reach out if you have any questions or concerns, or if you'd like any help reporting and meeting your obligations under this act. Thanks very much and have a great day.